Thanks for the reminder. Good. So in the first part of the lecture, we look at how much debt, how much a corporation should borrow. And secondly, we look at financing and valuation. In terms of debt financing and its advantages, the principal advantage when we look at debt financing is the tax deductible aspect of interest. All right. So here we're presented with two options. You have one firm, firm U, which is only financed by equity. So we're given the earnings before interest and tax of 1,000. There's no bondholders or debt providers for this company, so there's no interest that is paid on the earnings that is made. But then we deduct tax at 21%, so the net income available to stockholders, right? So it is critical that we know that the net income available for distribution to stockholders will now be the amount of 790, right? So that's the amount of money that is left in the till, and the directors will decide how much of that will be given out as equity, as a dividend, right? Based on what we covered earlier, or what we should have covered in lecture 8, looking at the retention and the dividend policy of a company, right? So the total amount available in company U that is financed only by equity would be 790, right? On the other side, we have company L, which has a mix of both interest and of debt and equity. So they would have earned the same $1,000, but because debt, there is an obligation that they'll have to pay, right? In this case, we said, they're paying 8% debt. We assume that they pay 8% debt. They've took $1,000 in equity, in debt, So they pay 8% interest, so that would be $80 they're paying in interest. So then the pre-tax income becomes $920. We take tax at 21%, that would be $193. So the net income available to shareholders, stockholders would be $720. But the total payout, when we look at both bondholders and stockholders, would be the $80 that is paid in interest plus the $279. So in fact, the amount of money that we will pay to the financier of the company would be $807. So we look at a company that is financed by equity, earning $1,000. They will only have, with a tax rate of 21%, they will only have the amount available to them, to the financiers of the company. In this case, it's shareholders. They'll have $790. In the case of company L, which is financed by both debt and equity, they'll have $807. And the difference that they'll have is what we call the tax shield, right? So the tax shield, which is 21% of the interest amount that they'll pay, which will be $17. So essentially, it says that of the interest you pay, you will experience or you suffer less tax of $17. So it's that interest that you pay times the tax rate is what we call the tax shield. And hence, those financiers of the company will have $17 more as a payout to them. You said some students are not getting into the class? Anyone have difficulty of getting into the class?
No, sir.
Oh, so but I got a message saying some students are having difficulty getting into the class. I'm not sure because I'm not getting any messages or so. Okay, great. All right, no problem. Right, so For a company that has debt in its capital structure and that pays taxes, so the company must have earned enough money to pay taxes, there will be a tax shield. And the tax shield that they'll have is the interest that they pay times the tax rate. Right? So essentially, if you have two companies earn the same amount, one whose capital structure is entirely equity financed, and the other which is financed by both equity and debt, once they would have earned enough money over that tax threshold, then they would have a tax shield, and essentially they'll have more funds available to their financiers, right? So that's one of the advantages that a company that is financed by debt, a mixture of debt and equity, will have over a company that is entirely equity financed. But then once we say this, and this example shows, the logical question to ask as a follow-up is, why would then some companies want to only be equity owned or equity financed, right? And we will see a little later why that is so, right?
Tell me about today.
Good. So in calculating the present value of the tax shield, what we'll do is just to take what we calculate the tax shield amount, which is $17, we divide it by and we assume that the cost of the debt was 8%, right? And then we'll get 220. So as the present value of the tax shield. Ironically, this 220 is related to the $1,000 in earnings that we have. So what the 220 says, and you'll see 21% of 1,000 is actually 210, sorry, not 220. It's actual 210. What it says is that of the earnings that you will, of the $1,000 earnings that you'll make, $210 will be the amount that the government, the tax amount that the government will absorb, right? So this will be the extra cash that will be available to the financiers of the company, right? So that's one way of interpreting this tax shield, or the present value of the tax shield, right? We're given the formula here, which says it's a tax rate times the interest payment upon the expected return of the debt, which was 8%. The corporate tax rate was 21% times the interest rate of interest payment of $80. So you get 17 upon 80, right? But once we use this, we assume a couple of things, right? One, that the debt is fixed and permanent. So we assume that this 8% will remain constant, right? And that whenever the debt matures, then that we replace that debt with the same amount and also in the same term, so the same interest rate. So that's one key assumption here. The next one is that you earn enough money to pay interest, right? So all of this tax shield then comes into effect. So one, the debt is fixed and permanent. Second, you earn enough to cover interest payments. Thirdly, that the corporate tax rate will remain as is. In this case, we're using 21%, right? So once all of the above conditions are met, then discounting the cost of the debt it becomes feasible, or the sensible thing to do, right? So remember, in calculating the tax shield, one, the debt has to be fixed and permanent. So even when it matures, then you expect for it to be replaced, same amount, same interest rate. Then the company must be able to, or you assume over that period that the company will earn enough money to pay the interest. And second and thirdly, you expect that the corporate tax rate will remain the same. Right? So the 8% is assumed. We just assume it's an assumption that we make. Right? So here we're given. Does someone has a question? So here we're given an example of a balance sheet. So we're given at the top of Johnson & Johnson's balance sheet an abridged version of the balance sheet. So we're given very simplified. So first you have the book values, right? So you have working capital of 12,551, long-term assets of 114,215. So you have total assets of 126,766. And those assets are financed by long-term debt of 30,675, other long-term liabilities of 35,931, and equity of 60,160. So it brings a total value of 126,766. But when we look at the market side of it, right? So this is simplified balance sheet, the book values, and then we look at the market side of it. So when we look at the market side, the market values, working capital will remain principally the same because they're fairly liquid. The present value of the interest of the tax shield would be 6,426 and 42, sorry. The long-term assets will be 426,257. And we'll tell you where these values come from. The long-term debt remain the same, long-term liabilities remain the same. But the significant shift that we will get comes from the revaluation of equity, right? The evaluation of the shares that we have in the company. So when we look at these two balance sheets, equity on the books is significantly undervalued when compared to what is the market value, right? And so we were saying here that, so we take this balance sheet as is, right? So we have the book values and we have the market values as is. And now we're going to try to do some finance engineering. So the first thing that the company will do is to replace, and just to see what's the effect it will have. So all these figures are assumed figures, right? These are assumed figures. So don't actually the present value, the interest tax shields. These are given figures to you just to ensure that it balances. Good. So now what the company wants to do is to replace 10 billion long-term debt will substitute for shareholders' equity, right? So on the book side, so we look at the book values and see what the impact will be. So on the book side, where we had 60,160. So what they did, they issue some debt of 10 billion and they replace, so that once they issue that debt, they repurchase some equity, right? So debt will go up by 10 billion, equity reduces by 10 billion, right? And you'll see that the long-term liabilities of 35,931 will remain the same, but then there's a change in value between working capital remain the same, and then you have a slight movement in long-term assets, right? So long-term assets have actually reduced in value. So long-term assets would have reduced in value simply because they might have had some amount of, impairment. But if you add it, we're missing some value here, right? We're missing a value here because if you add both of them, then you would not come to a net asset of 126,000. So the amount that we miss here is, so in fact, the only thing that it should have done in the books of the company, this figure here should have actually remained the same as 114 to 15. so that the balance, but the only thing it will do on the books, so this should remain the same. The only thing it will do on the books though is to increase debt by 10 million and reduce equity by 10 billion. So what they did in this re-engineering process is to issue new debt, take the funds that they receive from that new debt and repurchase their equity, right? So that's what it will have on the book side. So this figure should be the same. So it should be 114,215, right? So you could just correct this when you revise and note it. But on the market value side, this is what happened. So on the market value side, we would have had long-term debt going up by 10 billion. So it's now 46,775. Equity, which had a market value of 378,644, will now go to 370,744, right? And the difference will go here to the present value of the tax shield, because what happens now is that whenever the company refinances, not all of the benefits will go to the equity holders. Some, of course, will accrue to the long-term debt holders, because, of course, they'll have to pay interest. So that additional interest that they'll have to pay, that 8 point something percent, will come across and be shielded by the tax shield of the 21%, right? The long-term assets remain the same. So these values here are just values that show what are the likely effect that will have on the equity. And then they balance it with what is left with the tax shield. So it's just a likely scenario of what will happen when you refinance with a $10,000 long-term debt, right? So that is just a likely scenario. So it's not, as the example that we share with you is not, that is shared with you in the class here now, we've just assumed some numbers and just to show what is the likely thing that will happen, right? Good. So we want to examine what happens when you have two different capital structures and when you earn $1 of operating income. So in this example, TC is equal to the marginal corporate tax rate. TPE is equal to the effective personal tax rate, right? So the marginal tax rate is the tax rate that you pay on a next dollar earned, and the effective personal tax rate, it says that it is the tax rate that you pay, or the effective rate that you pay on the next dollar earned. So in a company that is only equity owned, and this is one that is paying interest. So here, you don't pay any corporation tax when you earn $1 on $1 of operating income, right? No corporate tax. Income tax becomes the same dollar, but you pay a personal amount. And this here you're looking at a financier in particular, right? So someone who earns $1, no corporation tax, but they're expected to pay whatever the personal tax is, right? So it's that dollar minus whatever the tax band that they find themselves. But someone who owns $1 and is in a particular company, then they'll pay on that dollar a corporation tax. What is left of that is then you pay an additional personal tax. So if you set up as a sole trader, right, you'll only suffer one tax, which is the personal tax. But as a corporation, for every dollar earned, you pay two taxes. So you pay a corporation tax, and then you also pay a personal tax on that, right? So bondholders, just a tax on the income that they earn. Equity holders, for every dollar they earn, they'll pay part corporation tax, and what is left of that, they will also pay an income tax on that. Right? So in principle, stockholders will pay 2 taxes, bondholders will only suffer 1 tax. So what drives us now to the relative advantage of debt? This is debt compared to equity. And the way we calculate that is to say TP is the personal tax rate on interest earned, TP is effective personal tax rate on equity income, and TC is the marginal tax rate. This formula, so when personal taxes are considered, the company goals shift from minimizing corporate taxes to minimizing all taxes paid by a corporation or corporate income. And so what happens in reality is that you should run companies as efficiently as possible so that you will maximize the corporate returns, or you run it in a way that you will pay the minimum taxes on the income earned. That's essentially the theory of the firm, right? Or part of the theory of the firm, that you run a company as efficiently as possible so as to minimize, and in a way that will minimize the taxes. But you will appreciate that companies have significant shareholders who exercise their influence in the way companies are run. So more times than not, they will influence the management of a company in a way that will minimize their taxes as a significant shareholder in a company. So they will want the company to earn and distribute dividends in a way that will minimize their taxes. Because you'll imagine that every tax holder will find themselves in their own tax bracket. And for some, it might be advantageous for them to be paid out a significant amount of money in dividends in this year, when their personal income might have been low, but in years when they have significant personal income, then they may not want a lot of dividends. So in that case, when companies are run by managers, they have to take account of the situation that significant shareholders might find themselves in. Because if they don't, then they run a risk of those investors withdrawing their financing from the company, right? Anyhow, back to this formula. This formula really says, when you work it out, what is the benefits that you have of debt in the mix in a capital structure. So let's look at this example. So in this example, we have interest. Let's say we have a bond holder on this side, and then we have an equity holder on this side. Right. We assume a couple of things, that the tax rate is 30 TP. Right. So the personal tax rate is 31%, and the effective tax rate is 15%. The effective personal tax rate is 15%. So someone who earns an interest of $1, they will not suffer any corporate taxes, because remember that $1 comes before you calculate that corporation tax. So you'll receive that as a bondholder. Then if you have a personal tax rate of 37%, right? So you'll pay 37 cents of taxes. So the income that you'll have after tax is 63 cents. But if you are equity holder and you have income of $1 before tax, then you have to calculate, you have to take out taxes of 21%, which is paid by them. So remember, the earnings is always earned by the company. Remember, those earnings are really the shareholders' earnings, right? Because it's shareholders who actually own the company. So they will earn $1, but on that dollar, you have to take out corporation tax of 21%. So they're down to 79 cents. And then they pay a personal tax of, let's confirm, and then they'll pay a personal effective tax of 15%, which will give you 11, almost 12 cents. So what they'll have is an income after taxes of 67, almost 67 cents. So if you are a debt holder in this company, you will be better off by 4 cents, right? Compared to an equity holder who also has to pay corporation tax and also have this personal tax to pay, right? So the relative difference between the two is that debt will have a 4 cents advantage. Any questions? All right, so we look at, in this chapter, we look at financial distress. So financial distress occurs when a company is unable to honor its obligations, or, and principally it might be servicing their debts. So you have long-term debts that carry a fixed repayment amount per year, or debts that mature at a particular time. You're not unable to pay that, or you have severe difficulty in making those payments. So that's what we call financial distress, right? And if we look at, if we incorporate financial distress in the value of the firm, so I've called this the updated value of the firm. The updated value of the firm would be the value if all equity finance plus the tax shield, right? So we treat it first as though the company is entirely financed by equity, plus whatever tax shield we would calculate, or the present value of those tax shields. And then we minus the present value of the cost of financial distress. So we'll look at the cost of financial distress, we'll assume how much that will be, and then we calculate the present value of that amount using a discount factor that is suitable for our company or our situation. And among the things that could be considered financial distress, one is bankruptcy costs. So bankruptcy occurs when the shareholders exercise the right to just walk away from the company, right? They have limited liability, so they may become a time when they can't pay debt holders, they can't pay suppliers, maybe they can't pay employees, and they said, what, I'm prepared to lose whatever I invested in the shares that I bought, and then they just walk away. So bankruptcy occurs when shareholders exercise the right to default, right? Of course, and then you have the whole administrative matters of receivership and so forth that comes in, right? And then there's what I call constrained business activities. That doesn't necessarily lead to bankruptcy, but it will have both customers and both principally suppliers though, curtailing the way to do business with a company, or they act in a more prudent manner. So for example, they may move from 30 days credit to 15 days credit because they might have sensed that something is going wrong with the company. So the way they operate with you now become a lot more constraining. Customers might, because of the way they view things, might demand that you give them more warranty on their products. So they become a lot more prudent and cautious in the way that they deal with the company. So your activities is curtailed. On the supplier side, again, they might stop supplying you on credit and take you to cash terms, or they might change the amount that they supply you, right? But all those things could drive you into financial distress. Oh, not to forget, but customers themselves might have gone into bankruptcy, so they can't pay you, and that could drive you in, have a ripple effect and drive you also into financial distress, right? So here you have significant bad debts, you can't collect them, so your company suffers. And then there's debt and incentives, where there's a conflict between bondholders and shareholders. When things get a little troublesome in a company, the company is going through tough times, there's always this conflict between bondholders and shareholders, and you will see through an example how this really operates. Who benefits in periods of financial distress, right? So here we look at debt and incentive as an example, and we have Circular File Company, which has a $50 1-year debt. Here we provided with the book values of the company. So on the books, we have working capital of $20, fixed assets of $80, so total assets 100. And we have bonds of 50, common stock of 50. The total value is 102 on that side, right? So assets are financed by two things: debt of 50, common stock of 50. Right? But when you look at the market value of the company, you'll recognize that the debt that you have on the books, well, first, let's start on the asset side. Sorry. On the asset side, well, working capital, because it's near cash, you seldom find that there is a, that the market value will be different, right? Or what we call it's impaired. Assets, fixed assets, you have it on the books at 80, but there's a significant impairment because now it's only valued at $10, right? Some of the things that might happen or cause that impairment is that you might have invested in a, let's say, specialty productive asset. You might have lost that particular customer. So now you end up with an asset that, you know, cannot produce anything for any other customer, right? You have on the right-hand side of the balance sheet, when we look at debt, the debt that we had of $50 is now being valued at $27, right? And then the common stock that you had, which was $50, is now being valued at $3. So significantly, the value of the shares has plunged. So now with a debt that is maturing, and which you'll have to pay $50 in a year time, the value of the company now is only $30. So even if you dispose of all of these assets and take the capital, you'll be unable to meet this initial obligation that you have. So in a situation like this, where the book values are exceed the market values of a company, then it's a signal that the company is in financial distress. And unless some affirmative action is taken in the near future, then you might be able to reverse this situation. But let's suppose, and in this situation, this is where we're going to see the trade-off between bondholders and stockholders. So debt financiers and equity financiers. So let's say, and the first game that they play is what we call risk shifting. So let's suppose that that Circular has $10 cash of that $20 working capital, net working capital. So we say of that $20 net working capital that they have $10 cash, right? And they have the following investment opportunities. If they invest the $10, there's a 10% chance that they'll have a return of $120 and a 90% probability that they'll just go bust, right? So they'll make nothing. So looking at this, just as you recognize it's a significant gamble because it's a meager 10% chance that they'll, you know, have a 12 folds return. What does a company do who's in financial distress? They've been in financial distress, they're more than likely say, no, look, we will take the shot with the $10 because, you know, there's a chance that we will get 120, and with that $120, then we can pay off the maturing debt of 50, and then, you know, we'll have $70 to really turn around the company. So let's say they undertook that investment, right? And they worked out. So the net working capital will drop to $10 because they've invested at $10. Fixed assets, when they worked it out, the NPV of that project, we assume that the NPV of that project is minus $2, right? So they've done their calculation and the NPV is minus $2. So the fixed assets that we had, which was 20, now becomes 20 minus 2, right? The NPV that becomes 18. The bond holdings now, right? So the firm value falls by $2. When we redid the calculation, these are given numbers to you, right? We found that the bond now outstanding becomes $22, but common stock rose to $6. So common stock before was 3, so we had 27 and 3, right? But with the investment, after we invested the $10, bonds moved to $22. So the net book, the market value of bonds is now $22, and stock rose to $6, right? Because what happens is that when you invest or you invest in a new project, the market might have interpreted as, okay, a turnaround is about to happen. So the value of your stock went up, right? Because of the investment that you make. Of course, you will know that you'll have a minus 2 NPV, but those on the outside will not know. But they'll just be using the signal of, okay, there's a new investment of $10. Yeah, so something must be happening for the company turnaround. But in this example, what you see, although they've taken $10 out of cash, bond value dropped to $45 and common stock went up by $3, so almost double, right? The lesson to learn from this, right, is that shareholders in a levered firm gain when business risk increases. There should be risk increases, simply because the signal that the company sends to the market by undertaking this new investment will make analysts or the market look at the equity a little bit more favorable, right? So just to be clear, these figures are figures that we assume, right? So these figures that we assume, these are assumed market values, but we know for sure that this will happen to net working capital, and we assume also that the NPV of the project is minus 2. But just to drive home the point that shareholders in a levered firm will benefit when business risk increases, right? So that's the first thing you should bear in mind. If on the other side, the investment was a safe investment and we calculate the NPV to be $5. So whatever it is, this is a safe investment that they have, right? So this is the second game that they play, and this is refusing to contribute equity capital, right? So when we left it, I've brought back to you the original market values that we had, right? So we had, when we look back at the original market values, working capital is $10, fixed assets 10, bond is valued at 27, and common stock at 3. With the $5 positive NPV, fixed assets will go up, right, by $25. And also, so in this case here, and also you'll have now bonds moving to 35. So all these are assumed figures, right? Bonds moving to 35. So that's an $8 gain. Common stock moves from 3 to 10, again, because of the positive signals that the market is getting. But in this case, whatever the value that the company will gain, right, the stockholders loses when bondholders gain in this particular scenario. So in this particular scenario where there's a positive NPV, the stockholders will lose what the bondholders will gain. So this whole value that is cranked up by $15, right? So remember, they will invest the $10 so that in the return they will get back that $10 that they invested plus an additional $5, right? So that will get NPV. So that's how we move from 30 to 45. So we invested the $10, we get back the $10, so we remain at 20, and the additional amount, we drive the fixed assets here because we would have invested in these fixed assets of 10, and now we get another positive NPV of 5, right? So in this case, all of the value of the firm doesn't accrue to the stockholders, right? Some goes to the bondholders. So the difference that doesn't accrue to the stockholders. So because of the positive NPV, the common or the equity went up by 7, and the rest of that value now goes to the bondholders, right? So in situation of financial distress, when there is a project with a positive NPV, the bondholders will not enjoy all the benefits of that project. The difference will go, the equity holders will not enjoy all the benefits of that project. The difference will go to the bondholders. Good. And then briefly, there are 3 more games that are played during periods of financial distress. So there's what we call a cash in and run, with essentially refusing to contribute equity capital, right? That's run in reverse. Then playing for time, so equity holders use delay tactics with creditors, right? So in this case, what we will do is try to fend off creditors a little bit more. And then there's the bait and switch. So they will start with a conservative policy, right? Then later switch and issue a lot more. So they'll come to the market and issue, let's say they're in financial distress and they want more debt. So they'll come, ask for a small amount first. And normally when companies ask for more debt, it's a signal that things are fine and that they will be able to meet those obligations. And then once that issue is taken up, then they'll come back to the market a little bit later and ask for more debt, which by that time would be, might be too late for those persons who would have issued debt to them in the earliest. Because once they come and they ask for more, then it's a signal to the market, then no, this company is in financial distress, and even the debt certificates that you hold, or the bond certificates that you hold, would be now worthless. Because you remember in the earlier lectures, there's also a bond market. So you can buy a bond from a particular company and then sell it on the bond market to another investor, right? So if they would have issued bonds at let's say $100 each with 8% return, in the first instance, let's say they did just $1 million, just to give a signal to the market that things are going well. Then they'll come back later and maybe go for $5 million. At that time, they might try to still keep 8% or make it a little more attractive and go 9%. But when they come back in a short period after, it would be a signal to the market that the company is in financial distress. So those who might have gotten or invested in that company when they issue that $1 million at 8%, might find the market now valuing that $1 million, and this is as a whole, at maybe half the price that you would have purchased it for, right? So that's basically the bait and run or the bait and switch game that companies play when they're in financial distress. Any questions? Any questions?
No, sir.
All right. So this one is more, a lot more theoretical this afternoon. All right. So in finance, there are 2 significant theories that are there. For one is a trade-off theory, right, of capital structure. And this theory of the capital structure is based on a trade-off between tax savings and distress costs, right? And it recognizes that target debt ratios varies from firm to firm, right? One of the things that we've observed from research and the empirical evidence shows is that companies with safe tangible assets, so the one that comes to mind is aircrafts, and those, so they have safe tangible assets and lots of taxable income. To shield, one of the things that they should do is have target ratios or have high target ratios. And company with risky intangible assets ought to rely more on equity financing. So for instance, if you are maybe into real estate or the airline industry where you have physical assets, right? You're saying good, you should have target ratios for debt. You can take debt and finance your operation simply because if you go bust, then the debtors have something to rely on, right? Company that has risky and intangible assets, you say, look, if you go bust, your IT company, most of your assets are in the brains of your programmers, the employees that you have. There's no way that a debt holder can tie those assets, meaning the programmers that you have to a new company, right? So then in that case, it would be better to be equity financed. So that's something that you should retain. And then there's also what we call the pecking order theory, right? So this is,
Excuse me, sir.
yes.
Could you kindly repeat risky tangible assets firm should rely on equity or debt financing?
So companies with safe intangible assets should rely more on debt, right? And also if you have, so you have safe intangible assets and you must be earning enough you must be earning enough profits to benefit from the tax shield, right? So if you're in that position, then debt finance is suitable for you. If if your assets are intangible assets, so copyrights, trademarks, so forth, then equity financing is the one that you should align yourself with, right? So that's a trade-off theory. The second one is the pecking order theory, and this one essentially says how you should finance new projects, right? So it essentially says that you should look at retained earnings first. If you have enough retained earnings or reserves in a company, then you finance new projects using that. And then if you don't have enough of that, the next thing you move to is debt. After debt, you move to those hybrid financial instruments, which for example might be debt that gives you a right to convert to equity. And then finally, equity should be the last resort when you're financing new projects. So another a critical feature of the pecking order theory is information asymmetry, which we came across when we did agency theory. But what it really means is that managers in a company will always know more about the company than outsiders. So they will know what are the risks, the significant risks that the company faces, what are the company's prospects in the industry or in the market, right? And those are things that outside investors or outside stakeholders will not, they will have an idea, but they cannot, nail it down to the T. So pecking order theory recognizes that there will always be information asymmetry. Right. So as I said, the implications for that, one, so firms prefer internal finance first, as I was saying, so that if the company has enough cash reserves, retained earnings, yes, then they should use internal financing. Secondly, it says that they should adopt a dividend payout ratio to investment opportunities while avoid changes in dividends. So they're saying that one, you should, ideally as a company, you should pursue every investment opportunity that has a positive NPV But in so doing, it should not affect the dividends, the level of dividends that you pay. So remember, dividends, the payment of dividends sends a signal to the market because you don't want it to affect your the price of your share, right? So you want to ensure that once you started that dividend, let's say if you're paying $10 per share, 10 cents per share, then you continue at 10 cents per share, because the minute you drop to 8, the market will interpret that as something going south in the company, right? So you adopt a policy, a dividend policy that will ensure at least you maintain that payment of dividend without though missing investment opportunities, right? Then thirdly, internally generated cash flow is sometimes more than capital expenditures. So you should finance first using internal funds. And then finally, external finance is required for firms. You know, you issue the safest first. So we start with debt, then we go to hybrids, and then we equity as the last resort. Right. So that's all of the pecking order theory says. It says where you should finance and which order the finance should come from. Right. Any questions? All right, so let's move on. So when we look at the trade-off theory versus pecking order theory, there's some evidence. So, and they've looked at basically 4 characteristics, 4 themes. So when we look at size, it says large firms tend to have higher debt ratios, right? So large firms, more than likely, and this is large by revenue, they tend to have higher debt ratios, right? Because they're generating lots more cash, so they might feel a lot more comfortable to carry more debt, right? In terms of intangible assets, it says firms with high ratios of fixed assets to total assets have higher debt ratios. So remember, fixed assets are those tangible things that the company will have. So just in case they're unable to service the debt, debt issuers or debt financiers of the company would feel a lot more comfortable lending to a company that has, lots of buildings. If you're into airplanes, if you're into hotels, they feel a lot more confident lending to you because they know that there's something tangible there that they can foreclose on later on if you can't service the debts. So the second thing we found is that company with a high ratio of fixed assets to total assets will have higher debts because of course lenders will be more willing to lend. Profitability. This one is a little strange one because it says more profitable companies have lower debt ratios. And then finally, market to book. It says firms with higher ratios of market to book value have lower debt ratios. Any questions? Any questions? All right, good. I think that brings us to the end of the first part. So maybe we can take 5 minutes and we can restart at 6:20. Just 5 minutes. So let's restart at 6:20. Okay, let's restart. All right. So on the second half of the lecture, we look at financing and valuation. As I mentioned when I started the lecture, this one should be a recap for you once you would have understood how we value debt and equity, right? So in this case, we have 2 ways of doing things, right? In financing and valuation, we could adjust the discount rate or we could adjust the present value. So this is 2 approaches. So the first approach, where we adjust the discount rate, we reflect we modify the discount rate to reflect the capital structure. So that would be like the weighted average cost of capital. We can adjust the discount rate to reflect bankruptcy risk and any other factors, right? So that's one way of valuing the company. So you get all the cash flows and then you adjust the discount rate, right? So we use the WACC. We might add an amount for the bankruptcy risk and then any other financial hardships that you might go through. You add another factor for that. Or we can adjust the present value. So we assume that the company is all financed all by equity, and then we make those adjustments for things like the present value of the tax shield, bankruptcy risk, and all those things, that some that add, some that subtracts from the value of the firm, right? So there are two ways to value the company. So the adjusted present value approach, you use the base case value, then you add value for financing side effects. So those side effects can be both positive and negative. So as I mentioned before, some could be bankruptcy, some could be present value of the tax shield, right? So in this case, you do all equity finance firm MPV, and then you value all of those costs and benefits, and you subtract it from that, or you add it to that, right? So in this case, also one of the things that one of the side effects could be what happens along the supply chain. If you start this project, if you have to forego, or if you take some production space, if you have to forego another product that you produce, or you have to reduce the quantities that you produce, all of those things have to be factored in as side effects whenever you undertake a project, right? So for instance, you might be producing also a product, and now you want to introduce a superior version of that product. So you treat the superior version first and you work on the MPV for that. And then one of the side effects for the corporation as a whole is what are the effects it will have on that low value or that earlier version of the product that you have, right? So you might lose some market for that, you might lose some revenue for that. That also has to be incorporated into the calculations that you have, right? Brings us back to one of our favorite things that we've seen throughout the course, but the weighted average cost of capital. In this approach, what we've added here now is the tax shield. So you recall RD would be the rate of return on debt. Now we will add, we'll incorporate the tax shield in the calculation. So what does tax shield do is effectively reduce the required rate of return on debt. We multiply that by the value of the debt upon the value, and it's the market value of the debt upon the market value of the company. Could you just mute your mic, please?
Thank you, Auntie. You said better, Auntie, and you well. Thank you very much.
Right, so just recall that D is the market value of the debt. B is the market value of the firm. So this is the market value of debt plus the market value of equity. E is the market value of equity. And RE is required rate of return on equity. Right? So that's the famous weighted average cost of capital formula again. And we'll use one example. So in this example, Sangria is a US-based company whose product aim to promote happy, low stress lifestyle. The firm cost of debt is 6%. The cost of equity is 12.5%. The market value balance sheet shows assets worth $1,250 million. Right. what is shared first is the book value. So we have assets of 1,000, and those assets are financed by debt of, and these are in millions, right? Of 500 million debt, 500 million equity. The market values of those instruments, the assets are actually worth more in the market. So the market has a positive view of the company. And the assets that we have in the book that is worth 1 billion is now in the market worth 1.25 billion. The debt remains the same. I would suspect that this debt is close to maturity, but the equity has higher value of 250 million, right? The book values, equity values, this is a fairly good position to be in. And now we're going to calculate what the weighted average capital could be like. So we summarize what was given to us, and we further assume that Sangria pays taxes at 21%. Right, so debt 6%, equity 12.5%. The marginal tax rate is 21%. So we could calculate the debt ratio. The debt ratio is 500 about 1,250. So we're using market values here, right? Just to recap, so you know we get that value. So the debt ratio is 500 upon the total market value of the firm, 1,250. So that's 0.4. And the equity ratio we can work out to, which is 750 upon 1250, which gives you 0.6. So this table summarizes it. What we take these values now and then we calculate the weighted average cost of capital, incorporating the marginal tax rate of 21%. So you'll see the shield being incorporated. So just to go back to the formula, as a reminder, the required return on debt is 6%. You now have the tax shield of 1 minus 0.21 times the debt ratio of 0.4 plus now the required return, right? The debt ratio of 0.4 plus the required return on equity, right? Times the equity ratio of 0.6. And now you have a weighted average cost of capital of 9.4% for Sangria. That's one way of, or this is the way of calculating the weighted average cost of capital, incorporating the tax shield. Right? So before we didn't incorporate the tax shield, but now we incorporate the tax shield. So the weighted average cost of capital for Sangria now is 9.4%. Moving on. Now there's a proposal on the table that says let's invest 12.5 million in the construction of a crushing machine. We're further told that the machine never depreciates and it generates a perpetual stream of earnings and cash flow of 1.487 million per year pre-tax. So we have a pre-tax of 1.487. We calculate the tax at 21%, which would be 0.312 million. So we have an after-tax cash flow of 1.175 million. Right. So always remember when we do MPV calculations, ideally we want to use the after-tax cash flows. So as I said, when I started the lecture, and this is a question from a student, no worksheet was posted for this lecture. So this is really a lecture and does not have a workshop element to it, simply because, especially in this second part that we do, I view it as a revision of things that we have done. But when we did it before, we looked at debt, and we look at equity, and we look at value and equity. Now all we're doing is valuing companies or branches or significant project in a company. And the previous chapter, how much to borrow, most of the questions are theoretical. So I trust that you'll just read them. All right, so hence no worksheet for this particular lecture. So significantly, you should note that after-tax cash flow does not account for interest tax shield on debt, which is supported by the perpetual crusher project, because it's already accounted for in the WACC by way of the lower discount rate. So here, right, so we have not included the tax shield here because in the discount rate, in the WACC, we've already incorporated the tax shield here. Right? So there's no need to double count. So now that we established that the after-tax cash flow is 1.6, so to calculate the MPV of this project, right, we need to invest 12.5 million. The cash flow that we will have in perpetuity is or the after-tax cash flow that we have in perpetuity is 1.147. The required rate of return, or the weighted average cost of capital, sorry, is 9.4%. And if we work out this, then we have MPV being just about 0, right? So in this case, it's barely acceptable. So it's barely acceptable in this case. When you look at this formula, and this will take for anyone, what does it resemble? Here we encountered the dividend growth model. This is very simple, where we add the discount. Well, if the dividends was the rate, the required rate of return used to be dividends upon the required rate of return minus the growth rate of the dividends. And again, this is similar. If you look at the dividend growth model, I think it's called, is a very similar formula to what we have here, right? But only now we're valuing investment, a significant investment in a particular company, right? Any questions? But here, of course, we're not told that there's any growth. We're just told that we just calculated the weighted average cost of capital. So if there was and growth is 0. So if the project was expected to grow by whatever percent, it would have reduced the discount factor, the denominator in the calculation. Any questions? All right, good. So valuing businesses. Here, when we value the business, what we want to get is the free cash flows. And then again, we use the same discount factor, so we calculate WACC is 1 plus the weighted average of capital with the power 1 in year 1 to the power 2 in year 2. Eventually to the final year, which we call the horizon year. So you get the present value of the horizon or the terminal value, and we discount it by whatever that is, right? So this is very similar. In dividend, it would have been DIV upon basically the same things. In debt, it would have been interest. So we've encountered this before. The only difference is that we're changing, instead of using interest in the case of debt and dividends in the case of shares, we're now replacing that with free cash flows. So the only, and we've come across free cash flows before, so it's just to calculate. So let's look at this example here. In this example, we are given free cash flow projections and the company value of Rio Corporation. So we're seeing sales, cost of sales. So sales minus cost of sales will give you earnings before taxes, depreciation, and amortization. And then you have depreciation. You calculate depreciation. So you have profit before tax. You calculate your taxes, which is, I think, 1% too. And then you have your after profit after taxes. And you have investments in, this is investments in fixed assets, investments in working capital, your free cash flow now would be, your free cash flow is calculated here. So this is, what they call it, 7 minus, so this is 1, 2, 3, 4, 5, 6, 7. This is after tax profit, 7 plus the depreciation minus your investments in fixed assets and investment in working capital, and that will give you free cash flows, right? And free cash flows from year 1 to 6, take from year 1 to 6, we give you 29 million, and then they've calculated the horizon value and the value of the company. That's given you here. Well, let's go to understand where they got the 77,000 from. 77.4 and the 106. Well, the 77.4 and the 106 is just the 29 plus the 77.4. But importantly, where they got, because we can see where the 29 came from, but where they got the 77.4. So we're using year 1 as an example just to see where they got the free cash flow from. So in year 1, we had profit after tax of 10.6. We added back depreciation because remember, depreciation is not a cash flow. Depreciation is just a book entry that we make to ensure that we calculate the right tax amount, right? So we add back depreciation and then we less the change in investments. So year 1 free cash flow would be the change in investment in fixed assets and the change in investment in working capital. So this will be year 1 minus what we invested in year 0, right? And the same thing for working capital. This will be year 1 minus what we invested in year 0. So it's just that incremental investment in fixed assets and incremental investment in working capital that is taken into account, right? So we'll get the free cash flow in year 1 of 5.3 million. So that's how we work, but free cash flow. So remember, it's profit after tax. We add back depreciation because depreciation is not cash flow, and then we less the incremental investment in fixed assets. So the additional investment you made in fixed assets. So if in year 0, you had initially invested 95, but at the end of year 1, now you see that the total investments in fixed assets is 109.6. All you want is that incremental part, so that difference, the additional amount of investment in fixed asset that you want to took in year 1. And the same logic goes for working capital. So working capital in year 1, the incremental difference, you would have started in year 0 with working capital requirement of 11.1, but at the end of year 1, now you have 11.6. So the incremental, the additional investment in working capital would be the difference between the value that you have at the end of year 1 and the value that you have at the end of year 0, which is the starting of year 1. So this is just an example of how free cash flows was calculated for year 1, and you can replicate that for year 2, year 3, and up to year 6. So we did that up to year 6, and we discounted that free cash flow by the weighted average cost of capital of 9.4%. So we get the present value of those free cash flows from year 1 to 6 of 29 million, right? Any questions? Are there any questions before we move on?
Yeah, so the previous slide is the write-up supposed to be minus and not plus, right?
Which one?
FCF, equal profit after tax plus depreciation plus investment in fixed asset.
Right. Yeah, correct. Good observation. Yeah. Right. Right. So, right. So let me, yeah, that's correct. So let me explain a little bit more. So if we invest in fixed assets, it means we are giving, there will be an outflow, right? Because it's additional. You've taken more money and that has been an outflow. If we invest more in working capital, yes, that's an outflow. On the flip side of that, so we could have a plus in investment to a plus in fixed assets, right? Because sometimes we could have disposed of the fixed assets and have an inflow coming back in, right? So just want to understand the part of it too. So if you didn't, let's say we had 95 at the start of the year, and we disposed some of it, and we got proceeds from that disposal. This when it could have been a plus, right? So it could have been. So it's a chance that it could also be plus. And the same thing from working capital. If you would have got back some working capital in the particular year, then it comes back as a plus investment. But good observation. In this event, we're investing more. So the formula here should have been minus. Good, thanks. Right, so that's how we get the, any other questions, any other observations? All right, so that's how we get to 29 million. I trust that everyone should be comfortable by now doing discounted cash flows. And then to get the value for the year, the terminal value, or we call it horizon value, what we did is to take years 8 free cash flow, year 7, sorry, free cash flow. And remember what we did for those years? And here we're assuming that from year 7 onwards, there'll be a growth of 3%, right? We assume that there's a growth of 3% from year 7 onwards, which effectively reduces the denominator. Years 7, free cash flow is 8.5 million. So we use that as the terminal value or the horizon value. We work out the PV of that. That will give you 132.7 million, right? But that's what's worth at year 7. And then before this, bring that back to year 0. So the value now, which is 1 upon the discount rate, the original discount rate of 9%, but we do 6 years. It's 1 year short of what we consider to be the terminal year. In this example, we're given a terminal year. We assume that it's where because we're given figures for 7 years, we go 1 year less, and we multiply that by that terminal year. And that will give us the PV in the current year. Remember from the earlier lectures when calculating terminal values, whatever that year is, if it's year 20, we calculate the present value of that cash flow, right? So if it's year 20, we calculate the present value of that cash flow, and then we discount that back to the current year using that horizon year minus 1. So if it's 20, then we do 19. In this case, it's 7. The horizon year is 7, or the terminal year. Or if we did debt, we call it the maturity year. This one is 7, so we use the year before. It's 6. So it's 1 upon 1 plus 9.4% to the 6th power. And that's how we arrive at the 77.4 as the horizon value or the terminal value of this particular investment. So we add that to the other 6 years cash flow of 29 million. That's how we get 106.4. And that's how we could value that particular investment. Any questions? Good. I hope this is revision for you, right? And here we just summarize it. So we summarize it now. So remember we worked out that when we did the WACC calculation, we worked out the debt ratio and the equity ratio. One was 0.4, one was 0.6. So now what we did here in this valuation is we found the valuation of the entire company. Right, the entire company of 106.4. We know that debt is 40%. So to get the value of debt, it would be 40% times the value of the company. And of course, the value of equity would be 60% of the total value of the company. And here you can split both debt and equity. Right. Questions? All right, good. So here we are. If we have no more questions, then we take an early night tonight.
Excuse me, sir.
Yeah, go ahead.
Sir, could you say, you said one of the signs have to change. Which one, sir?
Right, so in this event, so in this case, they'll recognize that in the example given, we had investment in fixed assets. So we have taken more money and purchased more fixed assets. So that's an outflow. Right, so outflows are minuses. So in the formula I gave you here, it says plus investments in fixed assets, plus investments in working capital. But it should be, if you invest additional fixed assets, it should be minus. If you invest additional working capital, it should be minus. But if you have divested, what do you call it? Yeah, divested fixed assets, so you sold it and you get proceeds, then it could be plus. If you recoup some of the working capital, then it could be plus. Right? So the updated formula should have been plus bracket minus, and then I put divestments and investments in brackets, so that you know that if you invest more, it's an outflow. Right? So you have to take money to buy more assets. If you have to take more money to fund more working capital, then it's an outflow and should be a minus. Right? Any more questions? So this is all you need to know from these chapters. Don't go fighting yourself with anything else. And for Sunday, just focus on what we did in chapter 7. Simply because I haven't done the voiceover for chapter 8 for lecture 8. Sorry. So Sunday's test, just focus on lecture 8. Nothing else. Sorry.
Which chapter, sir?
Just
Lecture
focus
7
on
alone?
lecture 7. Right. Just
Any
focus
other additional readings, sir?
and right, lecture 7 has some readings, so you should read them. Yeah, ensure you read the readings from lecture 7. So everything that is in the lecture 7
Thank you.
folder, make sure you know, because then I can bring all the questions from that. And because I'm not doing anything with lecture 8, then yeah, you should know the readings in lecture 7. Now, lecture 7 had a fair amount of reading. Any other question? If none, then you could enjoy the rest of your night, and I wish you well on Sunday.